Every few years, there's another headline, there's another crisis. Perhaps it's interest rates or inflation, an election, a war, a recession. And the reality is the headlines can change, but the feeling doesn't. And that feeling is uncertainty. I think it's really important when this happens, you reflect on your plan and recognize that it was never built for perfect conditions. Because if it was, and we only ever invested in perfect conditions, well, we'd never invest at all. So before giving you a framework of questions that you can ask yourself, let's look back in the past and not so far back. In 2025, Donald Trump announced tariffs. Those tariffs were very poorly received by the markets. Many stocks dropping 20% and some of the market dropping 25%. Now, at that time, if you listened to the headline and the recession fears and things everybody was talking about and saying and pulled your money out of the market, well, 6 weeks later, the market entirely recovered. And by the end of the year, it was up almost 20%. That is a 40% spread that investors would have missed out on, that I know investors have missed out on. Another great example is COVID. Back in 2020, it was a global shutdown. Businesses were shut down. Airlines were grounded for the most part. And there was depression in the headlines. Now, if we listened to that and we took all of our money out of the market, we took it out of the stocks that were down, 34% in less than a month, which is one of the greatest drops that we've had in history. If we reacted, if we listened, 6 months later, we would have missed the 34% recovery. And then at the end of the year was actually reaching all-time highs. So instead of reacting to the next big headline or the next big crisis that we're in, take a moment to reflect and ask yourself these questions. Number one, is your risk profile still in place? What I mean is we use what is called the maximum drawdown tolerance. So if you said, Dave, I've got $1 million, but in the next big severe economy, the next big crash, I'd never want to see it drop below $800,000. Well, that is a 20% maximum drawdown tolerance. You want to invest in a way that regardless of what happens in the market, it never drops below 20%. So in the next big crisis, if you ask yourself, is your risk profile still in line? And the answer is yes. Well, then your plan has been built to withstand the next severe economy. Because at the end of the day, it is a fool's errand to try and time the market. History and studies show us the most effective strategy is time in the market. Number two, do you have enough cash and income to float you the next 3 to 4 years without having to sell your stock investments? If the answer is yes, then it doesn't really matter, because if you look at history, the big financial crashes, the dot-com crash, for example, took 4 or 5 years to fully recover. And if you have enough money to float you through those years without selling any stock, then you're in great shape. However, if you say, Dave, I don't know what I would do after a year, I'd have to sell some of my stock to generate some kind of cash to pay the bills or expenses or whatever it might be, then you absolutely might want to reconsider the structure of your plan and put safeguards in place. Because combined with the income from your portfolio, your cash reserves, and your emergency fund, you absolutely want to have enough money to turn to for 3 to 4 years in a severe economy to make sure that you can float that without having to sell a bunch of stock at a loss. Now, a fun question, an important one, number 3, do you need this money next month, in a year, 5 years, or 10 years from now? If your answer is 5 or 10 years from now, then it doesn't really matter, because you don't need it to pay your bills today. You don't need it to fund a vacation today. That money is there for the long haul. A market crash really isn't going to impact that at all. Now, if you tell me, David, we actually do need this money in the next year or in the next 2 to 3 years, that's a very different story. Perhaps you're making a move across the country and buying a new house. Whatever the case might be, if the market collapses and you still need to pull that money out, well, now you're actually going to have to realize the loss, sell the stock at a loss to take the money out. There's a saying that goes, it doesn't matter how much risk you take if you don't need the money in 5 years. Now, while it's interesting to consider that, that doesn't mean you should take all the risk in the world. but it's a good way to shift your perspective. If you don't need this money in the next 5 to 10 years, then what does it really matter? History shows us that is way more than enough time for whatever economy crisis we're in to fully recover and build back momentum. Number 4, are you reacting to a market headline or are you making a thoughtful decision? Some of the biggest mistakes that we see as investors is because decisions were made from emotions, not from a plan and from math. So you want to get out of your head and out of your heart, step back and look at your plan analytically. Look at it thoughtfully. If you're reacting to headlines, it's probably a mistake. However, if you realize there is truly, a structural problem in your portfolio and in your plan, then absolutely consider making those changes. Just understand what is driving it. Is it emotion or math? This is a next really fun question, number 5. And be honest with yourself. If the markets were up 20% and not down 20%, would you still be making that change? And lastly, are you really worried about running out of money? Or is it just that you would hate to see your balances drop that much? At the end of the day, we cannot predict every storm. What we can do is build a resilient, thoughtful retirement plan and portfolio strategy that is built to weather them.